Fair value gaps are a great tool to include into your trading strategy, but if you are interested in using them, you need to understand what actually makes a valid fair value gap that's usable. So we've broken down everything you need to master FVG trading into 7 easy-to-follow tips. But first, we need to know how they work. Here we have a series of 3 bullish candles, and within their formation lies a bullish fair value gap. The gap forms when there is a space left between the first candle's top wick and the third candle's bottom wick, which is also known as a bullish imbalance. To give a simple explanation behind why imbalances are important, the chart likes balanced price action, and to achieve this, it needs to see both buyers and sellers taking part in the moves. So when we have a move that involves only buyers taking part, this creates a bullish imbalance, and the same happens when only sellers are taking part. It creates a bearish imbalance. Compared with this logic, this area is a bullish imbalance because it was a strong, impulsive move for buyers, meaning in the future we can expect it to act as a magnet for price to draw into before continuing the upward move. And in doing so, this area has now been rebalanced. We then also has the bearish variation, which follows the same principles. The only difference is that the imbalance is to the downside, meaning we expect price to push into it from below in order to rebalance the area before then continuing the next leg down. If there is no gap between the first and third candles, wicks, like in this formation on the right, it means the price action is already balanced, meaning there is no fair value gap to trade. So now that we've covered what fair value gaps are, let's start off with our first tip, which is that you should only be using FVG that align with the current order flow. Price can only go in 2 directions, but it rarely ever moves in one straight line. Instead, it makes many smaller moves, which together create the larger swings. In the case of an uptrend, we know that in order for it to remain valid, we need to see it create new higher highs. But after a high is created, we know a retracement is expected. And when the price comes down, it needs to find some kind of support that it can use to create the next leg up. And this is where we would look in the previous leg to find a bullish fair value gap that can provide the liquidity needed to continue the upward move. We can see a good example within this chart here. Every time we see a higher high form, we then see a retracement back into a bullish fair value gap where it finds the support needed to continue the upward move. As for downtrends, we know that in order for the price to continue creating new lower lows, it needs to find a form of resistance to create the next leg down, and this is when we would use a bearish fair value gap. We can see an example of this here within this downtrend trend structure. Every time a new lower low formed, it then retraced back up and into a bearish fair value gap where it then saw resistance before continuing the move down. So to sum this up, during an uptrend, we only use the bullish fair value gaps that form, and during a downtrend, we only use the bearish fair value gaps. This makes sure we are correctly following the order flow of the chart. Now moving on, the next tip is that you should never use an FVG that has been touched. For example, here we have a fair value gap, but if we look closely, we can see that the price has already dipped into it. Even though it barely entered the FVG, we still consider it mitigated, meaning it has become greatly weakened. And if we are looking for the highest quality fair value gaps, we may no longer want to consider using this one. But with that said, it doesn't mean this F will definitely fail if the price moves back into it for a second time. It's just a warning that FVGs that have already been touched should be considered weaker than those that haven't been. For our next tip, you should be targeting fair value gaps that are created within a discounted area. To give an example of this, here we have a strong bullish move, but when we mark out the fair value gaps, we have a few to choose from. So, question is, which one should we be targeting for our trades? Well, the first thing we should do is mark out the top and bottom of the move, along with the 50% mid-level. This will give us what we call the premium and discount areas of the range. To put it into simple terms, if we are looking for a long trade, setups found within the discount area will always be the strongest. So when we now look back at the chart, these highlight fair value gaps are the we should be targeting for our PPS long trades. And we can do the same for bearish FVGs within a downtrend. The only difference is we want to be targeting the fair value that gaps were created in the premium area, which is anywhere above the 50% line. Now we are moving on to some of the more advanced aspects, starting with our next tip, which is that you should look to combine FVGs on different time frames for a more precise entry. Most traders using FVGs choose to take trades from either the top, the bottom, or the middle of the gap. And while this isn't a wrong way to trade, there is a better way to find a more precise entry. Let's say we identify a fair value gap, FVG, on the 1-hour time frame. The problem is that this zone can be quite large, making entries less precise. To improve accuracy, we can move down to a lower time frame, such as the 1 5-minute chart. Inside the larger 1H FVG, we may find a smaller 5M FVG that formed during the impulsive move. This creates confluence between the 1H and 5M FVGs, giving us a more refined entry area and a stronger support zone for potential long positions. Many traders focus on the size of the fair value gap, but the most important element is actually the third candle that creates it. Before the third candle forms, we already know the potential size of the gap. However, what really matters is how that candle closes, because it reveals who is in control of the market. The strength or weakness shown by the third candle can significantly impact the quality of the FVG. If the third candle forms as a bearish rejection candle, it creates what is known as a rejection FVG. These FVGs should generally be avoided because they show strong selling pressure. Even if price reacts initially, there is a higher chance that the support will eventually fail. On the other hand, if the third candle is another strong bullish impulse candle, it creates a breakaway FVG. These are typically much stronger because they demonstrate aggressive buying momentum and often provide reliable support when price revisits them. Price is constantly seeking liquidity, which usually exists above previous swing highs or below previous swing lows. When price aggressively breaks through a swing high and closes strongly above it, we call this a liquidity run. If a bullish FVG forms during that breakout move, it becomes one of the strongest types of FVGs available because it combines trend continuation, liquidity consumption, and imbalance creation all in one move. Not every liquidity event is bullish. Sometimes price pushes above a swing high but fails to close above it. This is called a liquidity sweep. A liquidity sweep often signals weakness rather than strength. In these situations, bullish FVGs created during the sweep should be treated cautiously because the market may be preparing for a bearish reversal instead of a continuation higher. Always follow the current order flow rather than assuming every FVG will hold. FVGs work best in trending markets because the directional bias is clear. During consolidation, both bullish and bearish, FVGs can repeatedly fail, creating confusion and false signals. A useful rule is to wait for price to respect one FVG and then create another FVG in the same direction. This confirms that momentum and order flow remain aligned. If both bullish and bearish FVGs continue failing, it is often a sign that the market is ranging. In those conditions, patience is usually the best strategy until a clear trend emerges again. Because when we are looking for a bias and trend, we want to first see an FVG get respected, and from the move that then transpires, we want to see the creation of an additional FVG that can be used to further propel the price up. But then when we eventually see a bullish FVG fail, people immediately flip towards a bearish bias. But if the next bearish FVG that formed happens to fail too, this is when your instinct should tell you that there's a good chance we are entering a consolidation area. But if you're only interested in trending phases, you're going to wait to see when price next creates and respects two new FVG, as this will give you new short-term directional bias. If you found this video helpful, please leave a like and then comment what trading concept you'd like to see us cover next.